From the morning reading, the spider moves near the all-time high. Facebook breaks out to an all-time high. Baidu, Baba, JD surge. 6 of the 9 sectors moved higher on Tuesday. XLE, XLU, and XLK were the strongest sectors, while XLI was the weakest sector. Oil futures rose 68 cents to close at 44.88. Oil is forming a potential bull flag and a bullish harami from Friday. Breadth weakened compared to the prior session as advancers led 1792 to 1246 on the New York Stock Exchange and led 1541 to 1347 on the NASDAQ. The spider bounced to close at 219.03, just below its all-time closing high at 219.09 of August the 15th. We're looking for a horizontal breakout above 219.60 with a price target of 223.17. In other morning reading, the S&P 500 snapshot, weak non-manufacturing ISM, no worries. The S&P 500 opened higher but quickly sold off to its negative 0.22% intraday low with the 10 a.m. release of the ISM Non-Manufacturing Purchasing Managers Index, which hit its lowest level since early 2010. But a late summer buy-the-dip mentality prevailed and the index was trading back in the green by the lunch hour. After all, a weak services PMI on top of Friday's weak employment report will keep the Fed on hold, correct? Bad news is good news. The index closed the session with a 0.30% gain, just a few ticks off its intraday high, and a mere 0.17% from its record close. In fact, its tech-heavy cousin, the NASDAQ, did log a record close. The yield on the 10-year note closed at 1.55, down 5 basis points from the previous close. Stock and bond yields are not acting normally. Based roughly on economic conditions, stock and yields move in the same direction most of the time. Over the past 30 days, that has not been the case to such a degree that it is historically abnormal. While often regarding as a warning sign of future volatility, previous instances did not reliably lead to any particular performance in stocks, bonds, or volatility. Tech stocks reach a new record. The NASDAQ Composite closed at a new all-time high on Tuesday. It's unusual for the index to do so in September. The last time it did so was 1999. Because the seasonal trend is questionable this time of year, the index tended to struggle in the weeks ahead, but it was not a solid edge. Breadth momentum is finally turning positive again. The McClellan oscillator has been below zero for nearly 30 days before turning positive on Tuesday. But such persistently negative momentum in the market's underlying breadth is usually led to weak returns in stocks when the trend finally ends. There were 2 equity calls traded for every put on Tuesday. The put-call ratio was 0.5, was the lowest in weeks, and during this bull market since 2009, a ratio below 0.5 led to a next-day return on the S&P of an annualized negative 63.3%. That compares to an annualized plus 55.8% when there were more puts traded than calls. That doesn't mean the market hasn't risen after such a low ratio, only that returns have been skewed to the downside when it does. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:45 a.m. Mountain Time, and I am recording this in preparation for the market day of September the 7th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And there we go. A bit mixed this morning with the S&P futures and the Russell futures just below scratch. Well, let's see, the NASDAQ futures are up just above scratch, Dow futures just below scratch. Crude oil is down about 0.5%. Euro is down just below scratch. Long bonds are up about 0.5%, and gold is up just above scratch. In overseas action, you have China just above scratch, Hong Kong just below scratch, Japan down almost 0.5%, Germany up about 1/3%, and United Kingdom up just above scratch. So a lot of scratch in that conversation there. So most of these markets have not done anything of significance as of the time of this cut coming into this morning's action. In terms of macroeconomic reports for the United States of significance for today, you have the JOLTS job openings. And I think that's all I really see for the United States. Looking forward to tomorrow, we have the weekly unemployment claims, natural gas storage, crude oil inventories has moved from Wednesday to Thursday this week. And that looks to be about it of significance. In terms of current volatility conditions, short-term VIX very low, down below a 10, skew 131.16, so in the kind of warning area, so keep an eye on that. IV percentiles still remain exceptionally low, with the S&P at a 6, the Russell at a 14, the NASDAQ at a 5, and the Dow at a 5. There was one standard deviation move put in by the 4 indices yesterday, and that was on the NASDAQ. It was a positive 1 standard deviation. Let's go ahead and go to the charts. And here we have the S&P 500 charts, and you see the recent sideways price action. We tickled the lower side a few sessions ago, and now two sessions later, we're tickling the upper side, but have not broken out. We're waiting for something probably above 2,200 or below 2,100 on a closing basis to kind of really say something about getting out of this current range. We have talked a lot of range in recent months, and you know, when we do finally shift a range, we seem to just settle back into a brand new range right away. And that certainly seems to be the action here in the last several weeks. Summer doldrums aside, we're into September now, so that we would start to pick up in volume and volatility. Historically, September's been a tough month. You know, it's kind of looming out there as kind of historical probabilities. But that being said, nothing on the charts right now is telling us that something is imminent. And you look at the Dow also range bound and up near the upper part of its range. The Russell did set a new intraday high yesterday, and probably a new closing high as well. Let's zoom in on this a little bit. That was probably a new closing high as well. That one is moving a bit, and I wouldn't really call that one so much range bound as just very, very, very slowly continuing its progress to the bullish side. So slight bullish bias on the Russell, which is good for the market. We like to see the Russell and the NASDAQ, frankly, leading growth. They're usually the higher beta areas of the market. They're usually the growth-oriented segments of the market, and when they're moving, that's usually helpful to the overall bullish tendency of the market. In fact, let's go ahead and take a look at NASDAQ, and you see NASDAQ has followed through with yesterday's bullish action with a new intraday high in the overnight session. So let's see where the cash participants take that today. In terms of the other markets, crude oil has been, you know, something of that retracement. We talked in a previous video about this bounce off the 618. You see it even came back and revisited that 618 area before this most recent surge up. It's in the cloud now, so this would be seen as being neutral right now, in something of a balance of forces between the longer, more bullish trends and the shorter, more sideways kinds of trends. Obviously, the very short trend has been something of a downtrend, but something of an overall balance in those trends at this point. We'll wait and see where this pulls to. Now, gold has been moving, and gold, We talked about the fact that gold would probably come down just enough to shake off some stops and then turn, and certainly it has done that and is up near the diagonal resistance area at this point. If this is going to truly follow through on the bullish side, and gold has been a very sloppy technical pattern trade all year, we would expect that it's got to break through this diagonal and then break through the horizontal resistance. So a lot of resistance up here for gold, some tough sledding, but if we're going to continue to follow the pattern that's been developed for a number of months now, I would expect that to happen. A bigger question probably is when. Does it come up here, bounce off this diagonal resistance, and then go through the second time, from here, or does it just go straight through? We'll have to see what the other markets do, especially the dollar. And the dollar, of course, has a big part of this. You see, as gold bounced up, the dollar got crushed yesterday. So the dollar will certainly play a big role in gold being able to make that move. Also very sensitive to the dollar, of course, are bonds. And the long bonds still in this neutral consolidation, this very much sideways, slightly bearish, but now in the cloud pattern that we see on bonds. And it is also in a longer term bullish trend. So this sideways action, certainly would seem to be a counter trend kind of move of late. So we'll wait and see when that breaks out. Likely when this breaks out and the equities really break out, we'll all be at the same time. And then also VIX down here near the 3-year lows once again. Action yesterday took it down below 12. We have been as low as 11.02 in recent action, but all this is exceptionally low volatility type action for the markets at this point. Okay, that's probably enough on the charts. Let's go ahead and go to the daily report, and there are some important changes on the daily report. First of all, the market trend intermediate term phase opinion is still market phase 3, the bull Flagville kind of segment. But what has changed is in our 3 market timing signals. The IBD signal gives us our first one, and it's back to confirmed uptrend. So this is the first day back to confirmed uptrend, so we're always a little hesitant on that, but certainly in the context of other action that we're seeing would seem to be a confirmation that things have firmed up and that the bulls are in slight control once again. GMI index has been in a buy signal all the time since 7-1, and indeed both the GMI index and its GMI 2 signals are as strong as they get at a 6 out of 6 and an 8 out of 8. In terms of the third mechanical signal on our market timing signals from Stock Charts Decision Point Scoreboard, you note that we've had a number of green arrows come back in recent short-term action on the trend models. All 4 are now green. Those had been largely neutral, so those have improved. But you still got to put it in context. We still have mixed signals on all 4, on both the short-term and the long-term. So when you put the consensus of all this together, generally slightly bullish bias, but still with some sideways action expected and not any kind of strong trend at all to either direction, given these mixed signals from Stock Charts Decision Point Scoreboard. Position sizing opinions, both models now have turned back to 100%, so that was another change. Intermediate term market posture is back to strong bull on all the indices. Russell actually never fell into that weak bear. It managed to hold on to the severely strong bull all the way through the recent retracement action. But most notably, S&P back into the strong bull camp, followed by the Dow just above the 50 threshold, also in strong bull. And NASDAQ is on the threshold of going back above 80, which would be a severely strong bull. All this supported by a bullish sentiment line, so nothing really of concern to be talked about from that set of indicators. In terms of the strength of the trend, still up over 80, still very strong trend. Hedge warning status 0 plus, normal with some cautionary aspects. In terms of the three strategy opinions, option incomes, VIX is borderline acceptable. The VIX is just inside the acceptable window of a 12. So, it is possible to initiate new option income strategy positions for novice traders. Just keep in mind the premium here is pretty low compared to the amount of risk that's being taken. So you're kind of borderline acceptable. Cover call strategies and put selling, both of them are acceptable to initiate new positions for novice traders. Aggressive traders, especially so. Overall ratios to be used right now, we're suggesting, is a 3-to-2 ratio. 3 in the money with 2 out of the money strikes. Also a 3-to-2 ratio of low beta versus high beta. So this is a little bit more conservative than it was, say, a week or so ago, with a little bit more of a balance to in the money, a little bit more of a balance to lower beta. So just kind of keep that in mind. The market condition has been improving somewhat, and yet at the same time, we're not getting very clean signals, and we're certainly not getting very strong momentum signals to tell us that we're going to get a great deal of follow through. So most of your money on covered calls will probably be earned off of premium selling and not off of stock appreciation at this time. That's basically what these indicators are telling us, and this ratio is reflecting that. Put selling, it is a good opportunity to sell puts, especially on the individual chart patterns giving you pullbacks, especially a pullback to support. Take a look at that as an opportunity to sell puts or put spreads. Consider defined risk positions and position size and the scale you are willing to own. We are still not in the all clear by any means. So, your number of positions, your position sizing, the types of positions that you're taking should all be reflective of those conditions. Volatility-based warnings, you can see the daily squeeze is still present. We still have a relatively high distribution day count on the S&P, and the skew, as we mentioned earlier, is elevated and in the warning status. In the trend-based area, there are no warnings. In fact, we've got a positive signal for the bulls with the New York Stock Exchange new highs, new lows in the 1-month time frame at the 389 level yesterday. The key intermarket risk aversion indicators, though, are decidedly not as supportive. There are 4 of these that are mildly in the risk off stance, and one that is doesn't meet the squint test, and we're calling it neutral. Really, we probably should call all of this pretty much neutral at this point, a neutral with a slight bearish bias. And we usually look at the key intermarket risk aversion indicator as one of our more sensitive indicators of turns in the market. So, I'm definitely not discounting this. At the same time, they're so tightly wrapped. We're getting signals going back and forth as we've got this recent ranging action across almost all markets, and this is being reflected in this set of indicators. In terms of sentiment, somewhat elevated sentiment in stocks, both short and intermediate term. You see the fear and greed index at a 65, so up in the greed area, but certainly nothing extreme about it. In terms of the sector specific, you can see the individual sectors here from yesterday. Utilities universally green. Real estate, that's our new separated sector. Your REITs and so forth. Telecom, there's not a lot of companies in telecom, but you see they were all green yesterday. Followed by information technology and healthcare. Consumer staples also did quite well yesterday in terms of breadth, though overall performance was only a mild 0.28%. Now, in terms of not doing so well, financials and perhaps industrials or materials could be seen as less participatory in the action in terms of breadth yesterday. So That's a new graph we've been pulling from our reading, and very, very helpful. In terms of other ways to look at the sector specific, our market postures you see for transportation, consumer staples, energy, financials, industrials, materials, and technology have managed to return to a bullish stance in all three time frames. So definitely some pretty mixed signals here, though. Telecom, consumer discretionary, healthcare, and retail, as well as utilities, more neutral or perhaps even bearish kind of stances. So a lot of really mixed, and I would suggest don't make too much of this at this point. Many of these are fairly sideways in their own indicators at this time, and you're just a little bit of movement flips them all to three greens, and a little bit of movement flips them all to three downs or bears. It's just that kind of market where none of the trends are strong, and they often rotate one to another very, very quickly. And then yesterday's action, you see that here. And actually, I believe that may be in error. Just a second here. Nope, just double check. That's the right numbers for yesterday that were pulled from the data. So anyhow, that's where we have in terms of the percent change yesterday. One thing to probably note here, 1 day, 5 day, 1 month, there's a lot of chippiness going back and forth in the shorter term time frames. And again, we're just not getting strong short-term trends, everything very, very sideways. So that's kind of the theme of today's message. And you just don't want to make too much of anything until we break out one side or the other. And we'll go back to the chart real quick. And until you see the S&P futures break out above 2,200 with a closing basis, or break down below 2,100 on a closing basis, you probably really haven't, established anything. Right now, we're mostly in a 50-point range, maybe even smaller than that. And, that's just super, super small range for the S&P. And that's what's ruling overall market action at this point. So, gone long enough for today. Let's go ahead and wrap this thing up. I'm going to kind of scroll through these slides. If you see anything of interest, just hit the pause button, get the additional information, go to the hyperlink that will give you the additional information that you are looking for. But we're going to go ahead and go to the disclaimers. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note at the bottom the hyperlink that takes you to the full set of disclosures. We'll see you back here for tomorrow's market preview session from Falcon Global. In the meantime, manage that risk, and you should see that everything else should fall into place. And in the meantime, good trading to all of you.